Good afternoon, everyone. My name is Iqbal Branch. I'm the head of marketing for Advantage Futures. I want to welcome everyone to our seminar today. I want to thank Patrick Birley for putting on the presentation on opportunities in the carbon market. Patrick is the CEO of the European Climate Exchange. He's got a great history with the futures markets. He was just telling me dating back to his 20s when he became the second employee at the South African Futures Exchange. Since then, he's also been the CEO of LCH ClearNet, and as I mentioned most recently, the CEO for the European Climate Exchange. With that, I'm going to turn it over to Patrick. He's going to talk for about 40 minutes. We'll have Q&A, and if you have questions for Advantage Futures, we've got a couple of representatives, so feel free to track me down as well. Thanks, Patrick.
Thank you. Well, thanks very much indeed for turning up with the weather like it is outside. I'm not sure I would have made the choice you have, but anyway, thanks for making it. I just will plan to give a sort of fairly basic overview of how the carbon markets work in Europe and to talk about the way that we operate. And I'd like to, it's always difficult with the carbon market audience to know how to pitch it and how to pitch it in a way that just gets you excited and motivated about what's going on and perhaps what the opportunities are. So if you feel I'm talking down to you, then say so. I can elevate the level. Or if you feel I'm getting too complicated, then please, again, say so. And I'm happy to try and simplify it a bit. Just in terms of ECX, we are European-based organization, but we do have my colleague Megan, who is based here in Chicago, and should be, with her hand up over there, and should be very happy to talk to you one-on-one at any time about the way that we operate. Is one-on-one not something I should be saying? I saw a few people grimacing there. So yeah, and just in terms of my English expressions and my use of the English language, you'll probably pick me up on other things, like we talk about the European system as being the European emissions scheme, and I know that as soon as you say scheme in the States, people start sort of cringing, and but in Europe, scheme is not necessarily a prerogative or a term that is negative or has negative connotations. In terms of the organization I represent, it's the European Climate Exchange. I am the sister company of the Chicago Climate Exchange here in here in your town, and we are both owned by a UK-listed company called Climate Exchange PLC, which is currently under offer and is being bought by ICE, the Intercontinental Exchange. The transaction is due to be completed in about 4 weeks' time. So at that stage, we'll just be part of the Intercontinental Exchange. We trade on the platform. We've been partners with them since the inception of the business. So frankly, it's a no-change option in terms of the market and the way it operates. But in terms of ECX and the bit that I represent, just over 99% of all carbon that's traded anywhere in the world trades through ECX, or 99% of the carbon derivatives trades through ECX. There are about 6 or 7 exchanges that offer carbon-based products. Everybody but ECX shares 0.88% of the market. So, and I know that sounds probably a bit cocky and a bit over the top, but it's just how the market's developed. ECX seems to be the place of choice. We offer the benchmark product that everybody trades, and we have been reasonably successful in building the business over the last few years. We also trade about 40% of the spot market product, the delivery product for delivery the next day, but the spot market's about 10% of the size of the derivatives market, so it's a much smaller market, and that's a market share that we're in the process of growing at the moment. Before I talk about carbon markets, always the most important thing to talk about is to try and understand and get right in your mind this system of cap and trade. When the system was introduced, I think probably the biggest mistake that we made in the whole system was to call it cap and trade, because everybody focuses on the trade part of it. The trade part of it, you guys are all involved in making money, losing money. People get really excited about that. It's sexy, it's fun. But from an environmental point of view, trading has no impact whatsoever. In fact, it probably has a negative impact in terms of the carbon going into the atmosphere. The trade part of cap and trade is completely irrelevant in terms of the carbon going into the atmosphere. The environmental benefit that is delivered by the system is entirely delivered by the existence of mandatory caps. Putting a cap on the amount of carbon that can be put into the atmosphere by industry creates a shortage in a commodity, and if you've got a shortage in a commodity, you've got a reason to trade. But it's a horse and cart. Trading without a cap is completely irrelevant. There is no point in it, it has no issue. It is only the existence of the cap creating an artificial shortage in a commodity that creates the opportunity to trade and the need to manage the risks associated with the shortage that's being created. So I get lots of people coming along from different areas of the world. They've seen the success of ECX in Europe, and they say, we want to start a carbon market in Australia or Taiwan or India or any other part of the world. You can't. Until the policymakers put in place a cap, create a shortage, there's nothing to trade. So cap and trade, understanding the different roles in terms of that is important. The cap is the policy vehicle that creates an artificial shortage in something that people didn't realize they needed in the past. So the cap bit of cap and trade is what delivers the environmental benefit. What we do in terms of a platform and what the people who are trading on us do is to manage this new risk that they have in terms of the cap that's being imposed upon them. So it's just important to really try and understand that this cap and trade thing has two segments. One is the policy bit, which delivers the environmental benefit, but that creates a trading opportunity because you've created a synthetic shortage in a commodity. And in terms of cap and trade, this was the mechanism came about in 1997 as a result of this Kyoto Agreement or the Kyoto Accord. And coming away from Kyoto, really, Europe took a leadership position and said, we're going to implement the commitment that we've made to introducing a cap and trade mechanism. It appears to me that many other parts of the world just disappeared away from Kyoto and just thought, oh, well, that's 10 years away, we'll deal with it later on. Europe has taken a leadership position. We, even ahead of the Kyoto commitment, put in place a sort of test system from 2005 to 2007 called Phase 1 of the emissions trading scheme, which was a complete nightmare, a failure in almost any measurement, in that the carbon price dropped from an initial about 30 euros a tonne to 1 cent a tonne, because they made some key mistakes in the design of the system. Two key mistakes, really. One is that they over-allocated the amount of permits that were needed. And secondly, they said at the end of this scheme one, if you had any permits left, the value disappeared. So of course, if you've got an oversupply of something which at an end date has no value, then if you can sell it for a penny today, you'll sell it because it's not going to be worth anything tomorrow. So those two mistakes were made and recognized. As a result, the scheme that we have now is much better, much improved. What's known as the Phase 2 of this emissions trading scheme in Europe, which runs from 2008, 1st of January 2008 to the end of December 2012. And that coincides with the Kyoto period. This thing called the emissions trading scheme, it's binding across all of the 27 member states. But again, the Europeans have been quite pragmatic in their implementation. It only affects 5 industry groups. The utilities, the power producers, oil and gas companies, steel and heavy metal manufacturers, pulp and paper, and cement and glass. Those five industry groups are now subject to caps on the amount of carbon that they can pump into the atmosphere. Those 5 industry groups account for 46% of all European emissions. So by attacking only 5,000 companies, or by putting these controls in only 5,000 companies, we've got 46% of the pollution or the carbon emissions covered. The intention over time is to slowly go down the distribution curve to more companies or to more sectors. Airlines come in 2012, shipping comes in 2013, and they're picking off industries where you get a reasonable return in terms of the difficulty of measuring versus the amount of carbon that they're pumping into the atmosphere. So it's not fair. They're not ticking off industries one at a time. They're just going for reasonably pragmatic implementation. And of course, they missed out the biggest emitter of carbon, which is the agricultural sector, because in Europe we can't do anything with agriculture because they get all upset and come and dump their pigs in the streets of France or Paris or in London. So we just said, oh, well, that's too difficult to deal with. Let's get on and do the bits we can do, and over time the system will be extended. We're reducing, by the end of 2012, we will have reduced our emissions in Europe by 8% from 1990 levels. And when you hear other countries talking about reductions, they might be talking about reductions from a different level. And in terms of our reductions in Europe, 88% on average across Europe has to be your own reductions, you reducing as a company. 12%, a maximum of 12%, can come from you helping other people in other parts of the world, and only in the developing world, to reduce their emissions through a system called the Clean Development Mechanism, which is a sort of UN overseen system where if you can, on a more cheaper basis, you can reduce a ton of carbon going into the atmosphere in Sao Paulo rather than where you're located, then you can. For 12% of your reductions, you can do it by helping somebody else, which from a commodities point of view, you'll do if it's cheaper. If it's cheaper, you will do it up to the maximum extent that you're allowed from a industrial point of view. The scheme is in place until the end of 2012. We're currently finalising the next phase of the scheme, which will take us through to 2020, and is likely to be, well, it's likely to be a 30% reduction between 2012 and 2020. So another huge reduction in the amount of carbon going into the atmosphere over that period. So just on the policy side, and I'm not going to concentrate too much on the policy side, but it's just so important to recognise again, these are mandatory caps. If you want to produce electricity in Europe, you need a big furnace, you need coal or oil or gas, and if you burn any of those fossil fuels, you need these permits. Otherwise you can't. So it's mandatory. There's no choice. You cannot produce electricity if you come from one of those 5 sectors in Europe unless you have these permits in place. It's mandatory. So it's a commodity you have to have. So just in terms of people who are trading in the market, or certainly the industry players who are trading in the market, they're not trading on ECX because they're good people, or because they want to save the world, or because they like bunnies, or any of that sort of stuff. They're trading on ECX because they have a commodity which they have to have, and they need to get certainty of price moving forward. They need to manage the price risk around it. So, you know, we're not sandal-wearing hippies who are working on the exchange or working in the market. It's just a commodity market. It's a commodity market. That's all it is. The environmental good is done by the policy people who've put it in place. We're not good people. Well, I'm obviously a very good person, but in terms of the products, only 2 products. EUAs, which are European Union allowances, which is a sort of European currency for European reductions. And then CERs, certified emission reductions, which are these international products which are certified and overseen by the United Nations. And they're much smaller, about 8–10% of the volume is done in these CERs. And again, I should emphasize, they become a commodity at the point that the UN put a stamp on them saying, this is a good product. At that point, it's just a commodity. And you can submit it to the authorities for your reduction units if you are an industrial player. So before that, when they're sort of developing these projects and they're looking at how they operate, it's not yet a commodity that you can use. So we're not interested, we're only in secondary CERs in that side of the market. And for both those, we have spot products, futures, and options trading. And the futures trade through on the EUAs right through. It's an annual futures contract. We have quarterlies, but the quarterlies don't trade. December is what trades, or the December month trades. And just the history behind that, because unlike your other input costs into electricity, the coal you need every day to go into your furnace, these certificates you only need once a year. So once a year there's a true-up process where the little man with a clipboard comes along and says, okay, you've pumped 8 million tons of carbon into the atmosphere this year. He goes into the registry account, your registry account, and he removes 8 million certificates from your registry account. So annual true-up process that exists. If you don't have 8 million in your account, you are in deep trouble. There is a punitive system where you are not only fined the full cost of the permits that you're missing, you'll then find an additional 100 euros a ton for that, and then you have the same amount removed from your account for next year as well. So it's just, it would be insane ever to not have enough in your account at the time of that true-up. It would just be, it would be a monumentally stupid thing to do. In terms of the price of these things, this is just looking at the front December price over the last 3 years. And you can see if we take the blue, which is the EUA, which is the main instrument, it's ranged from as high as 30 euros a ton down to about 8 euros a ton. And just to be clear, that was oil at about 146 a barrel. That was oil down at whatever it got to, was it 45 or something a barrel? I can't remember what the range was. But it's, the price of these things has been gapping, or has gapped around quite a lot. We went through a period from about April, May 09 through to about April this year, where it's very tight price range of only about 2 euros between them. It's broken through that range recently up at about 1560, 1570 euros today. So worth just noting in terms of that, the only commodity, I think, anywhere in the world that's traded in euros, so there's a foreign exchange element to it. All the other input costs into energy production in Europe priced in dollars. This is priced in euros, so obviously there's a pricing issue in there. But just to look at some of the other pricing characteristics of why these things are moving around, important just to step back from it a moment, because it's quite a unique commodity class that we've got. It's unique because you have an entirely inelastic supply curve. The supply curve is announced in advance by the government. It's fixed for the period, and each year the reduction is announced, and the reductions that we're working to now through to 2012 were announced in 2005. We're about to announce the reductions that will be in place right through until 2020. So, and that supply curve fixed, totally. No elasticity on the supply curve whatsoever. So the price is entirely driven by demand. Demand is the absolute key. And in terms of demand, you know, in terms of Europe, it's the demand for energy. And obviously, again, if we go back to that slide, you know, as recession started to bite and the furnaces at steelworks and the furnaces of the big industrials started being turned down, the demand for power dropped, so the demand for these credits dropped. So the price dropped. And theoretically, the price should be slightly more volatile than the other input costs into electricity, because the other input costs have at least some elasticity on the supply side. But here you've got a completely fixed and inelastic supply side. So whereas oil, you know, we can tap, well, I shouldn't say we can tap oil wells, because we can't even tap them when we don't want to, but you know, we can adjust the supply of oil or coal or gas. With these things you can't. It's announced in advance and it's fixed for the period, that's it. So as demand changes, it should be slightly more volatile than the underlying oil products or oil, gas, and energy products. But it's clearly influenced by, as I say, exchange rates, by weather, by energy costs, particularly in Europe at this stage. Those are the key drivers. But there's also some quite interesting other plays, again, in terms of an annually supplied product. This is a commodity, but there's no storage costs whatsoever. So you have you should have, in theory, a simple interest rate forward curve, which you actually don't. Why? Don't know. But you've got EUAs, which at the moment are in contango, as you would expect them to be. But on CERs, you've got a backwardation. So you've got products that go out up to 5 years, one in contango, one in backwardation. You've got all sorts of interesting factors involved in in those prices, and why? The whys are we're learning as we go along. Frankly, I mean, part of it is that this is a new market. What influences come to bear is something that we're learning as we go along. And initially, these prices were very, very closely related to German power, and you could see the correlation extremely closely. Over time, they've drifted away from German power, and they have more and more of their own characteristics in terms of pricing. So just something to be aware of and to think about in terms of these, the way that the price is set. In terms of as a marketplace, we are a risk transference market, we're a futures market. We're here to provide the hedgers, the industrials, the utilities with a risk management tool, an opportunity to manage their price risk moving forward, to have price fix or price setting mechanism for as far forward as we can. But in order for them to offset their risks, we have to encourage in people who want to take on that risk. And normally, when I'm in the States, I change speculators to liquidity providers just to keep the regulators off my back. But we all know what we're talking about. We have a very good mix of investors, long-term investors, who are looking at the fact that you've got this restricted supply moving forward and are thinking about the impact of that on price. A very large group, an ever-increasing group of arbitrageurs who are looking at the interest rate curve, are looking at the products against each other, are looking at the whole energy complex and the impact of these products in the energy complex. And then we've got a slowly growing community of prop traders, of algos, of others who are starting to get involved and to look at the products and how they operate. In terms of how the market's grown in trading volumes, this market has become pretty significant. I mean, you see these graphs, and you always have to be careful of the scales. When we started in 2005, we traded 95 million tons in the year. 2006, 450 million tons. 2007, 1 billion tons. 2008, 2.8 billion. Last year, 5.1 billion tons of carbon traded through ECX. This year, we're on target for somewhere between 7.5 and 8 billion tons we'll trade through. So we're trading about 35 million tons a day of carbon through the exchange. 35 million tons at about 15.5 euros. Where is the euro today? I don't know what that works out at, but it's the numbers are pretty significant. On the front month DEC 10 contract, which is the main benchmark price point, you've probably got a 1 or a 2 cent bid offer spread, and each contract is 1,000 tons of carbon at any time. So the bid offer spread is narrowing all the time, and clearly on the front month it's quite close to ideal already. In terms of the open interest in the market, again, this is an interesting number, and the open interest, this is a utility. This is an early utility market where we still have a very high percentage of hedging, utility hedging in the market. We've got open interest of 931 million tons of carbon at the moment. We've got open interest just in the EUAs, which is almost the same as the open interest in Brent on ICE. So it's a huge open interest pool relative to the trading volumes, which I think, again, is indicative of a relatively early market. Still got a very high degree of hedging capacity or hedging activity in the market. Just in terms of, this was the original sort of Kyoto design that everybody wanted, that Europe would have its little emissions trading scheme, system, whatever we want to call it. Australia would have theirs, New Zealand theirs, Japan, Canada, and you guys would all have our own emissions trading schemes with our own unique characteristics. So Europe chooses 5 industries, you might choose 10 different industries. It made no difference. The whole point of this Kyoto Agreement was each emissions trading scheme could have completely its own characteristics. You, as a nation, decide what is the right thing for you to do. The hope was that we would all allow some of these CERs into our schemes for, in Europe's case, 12%, in order to just keep the schemes vaguely bound together into some sort of cohesive unit. With the long-term, 2-generational aim, that actually we've only got one atmosphere, and whether a ton of carbon is pumped into it here or in Joburg or anywhere else, it's all the same. So really, very long term, the aim is to have a single global emissions trading system that would all be the same. In reality, only Europe has gone ahead so far. Australia's wimped out many times. New Zealand's so small we don't really care. Canada. Clearly the big issue is you guys and what you're going to do. And your scheme system, when it comes in place, should be at least 3 times the size of the European scheme. The amount of carbon you're pumping into the atmosphere is 3 times. And my view is, just to be clear, maybe you haven't done it yet. Maybe the lobbyists are going to manage to put it off for another year, or another 2 years, another 5 years. We know it's wrong. We know. The scientists, you know, you might find an outlier scientist who's prepared to say this is not the case. We know that we've got to stop pumping this stuff into the atmosphere. We know we have. So caps are going to come at some stage. So you can avoid it for a while, you can avoid it for now, it's coming, and you need to be prepared. There is no other alternative. There's no silver bullet out there that's going to make this issue go away. So, you know, be prepared, it's coming, whether it goes in this form or not. And the outliers here, again, China and India. You know, particularly when I'm in the States, I hear a lot of people saying, well, if they're not going to do it, we're not going to do it. Just to be clear, the reason why Kyoto was set up on the basis that we have to go first, we have to show leadership, is that we, as the developed world, have benefited from 200 years of pumping this shit into the atmosphere. We filled the glass to about there. Yeah? So what Kyoto said is that you guys who have filled it to there and have benefited from cheap electricity through the last 200 years, you start to show that you can reduce it. And when you start to show that you can reduce it, then we'll ask the guys who are currently benefiting from the uplift of their economies, we'll start asking them to contribute. And in fact, what we're seeing now is we're seeing more action coming from places like China and India than we are from the States. And my view is you should be hanging your heads in shame as a nation. But anyway, I'm going to get lynched before I leave if I go on too much about that. So in terms of carbon and in terms of reducing carbon, there's loads of different things that have to happen. Cap and trade is not the only thing that has to happen. We all have to be a bit more conscious about what we do. We have to have renewable energy systems. We have to have voluntary markets. We might have to have taxes in certain industry sectors, no question. In Europe, remembering we only have cap and trade for 5 industry sectors, it's very possible that taxes will be brought in for other industry sectors where it's too difficult or not viable to have this sort of simple measurement. But let it make no mistake, taxes are far less flexible, far more costly to a company than a cap and trade scheme which allows you to not only which allows you, if you move quickly, to benefit relative to your competitors from cheaper fuel prices. So mandatory cap and trade, my view is, can deliver this sort of wholesale change, but it's got to be part of a package, and there are different things that need to be done at the same time. In terms of the market size, you know, this market did not exist at all when it started in 2005, so it came from nothing. Last year, about 140 billion tonnes of trade through through the exchange, $140 billion, from 0 to $140 billion in 5 years. It's a huge growth rate. The projections, and there are different analysts with different views, but by 2020, something like $2 trillion a year as a marketplace. If the US adopts, if China starts to adopt, people are saying mid-2020s, late 2020s, it'll be bigger than the global oil market. And we can, whether it is or it isn't, the growth rate is phenomenal. The potential for the market to grow is huge, and I would clearly think that people should be looking at it and thinking about the implications. As I say, we trade on the ICE platform. Anybody who's a member of ICE or who's operating through ICE can pick it up. All of the vendors are connected to ICE, and you can pick up the pricing from there. Very straightforward. We're a regulated market, regulated under the by the FSA in the UK. It's easy to access. We're transparent. It's a simple market, only 2 products. And if you can get your head around the cap and trade issue and the different parts of it, hopefully you can see how the market might have some potential in terms of trading opportunities. That's kind of it from me in terms of an overview. I'd very much like to hear some questions or to try and answer some questions. I spend virtually all my life talking to people, talking to groups. Sometimes you get masses of questions, normally from university students you get more than any others, but sometimes it's also from sort of older generation we get some good pointy questions too. So don't hold back. Yes?
With the limited supply, isn't there how do you keep away from somebody cornering the market? I mean, that's one of the...
Well, again, the market is only traded on, I mean, the OTC market is minute. The OTC market kind of disappeared post-Lehman's, and because it's only 2 products and it's very simple, it's highly commoditized, virtually all the trading happens on ECX. We're a regulated market, so we have position limits and all of that sort of stuff in place that you have. But just think about the size of the market. I mean, it is the annual crop, if you like, in Europe is 2.1 billion tons. So times 15 euros, cornering it, assuming there were no controls whatsoever, would be, yeah, it's the sort of question that regulators always sort of say, and you go, well, come on, A, we can see, and there are limits in place that can be brought to bear, but B, the market is just huge.
Regarding the true-up period, is that, how does that work? Does each company, is there any kind of like seasonality to it or cycle, or this company might have to true up in, say, January, this company has to true up in February?
No, the true-up happens in April every year based on figures as at the end of March. So the true-up happens, so March is the year is up to the end of December. Then the verification process happens up until the end of March, and then the true-up has to happen on the last day of April. So, and that's for all industries. So on the 30th of April, or whatever the date is, essentially the government goes into the registry accounts of the 5,000 companies and removes out the number that they have has been defined as the amount of pollution they pumped into the atmosphere.
Do you see an increase in volatility or volume in April?
We see an increase in spot market activity around that period. And again, it's, you know how markets develop imperfectly. I mean, it's interesting that the market theoretically actually should be focused on the annual product, should really be the March product. But in reality, because that's closest to the true-up, but in reality, the annual product is the December product. So you have an increase in activity between December, which is when the main futures contract annual product expires. You have an increase in activity during the first 3 months as people are then managing that risk through until the true-up. So there are imperfections and kinks in it which have sort of developed even in this very short space of time.
Peter, my question would be that I keep reading about how the EC is talking about ratcheting down the requirements from 20% targets to 30% targets.
Yeah.
And that would be effective. I believe they're talking about doing that for phase 3.
That's right, yeah.
I've asked a few people this question, and I've gotten different answers. And I think I know the answer, but maybe you can really answer it. Are the permits that trade now bankable?
100%, yes.
100% bankable to the next phase?
You can bank through to 2000, bank through to phase, but you can't borrow between phases. So you can bank, but you can't borrow. So you can't borrow from your phase 3 to sort out your phase 2, but you
move them from phase 2 to phase 3.
100%, yes.
So there's this underlying bullish tone that if they change the rules, I mean, the current credits become worth quite a bit more.
Yeah, that's exactly right, and that's that. That's that. And you know, I think that, well, I mean, again, you can never say that's that, but a large part of that is that European utilities at the moment are actually quite long cash. This is a bankable product through to 2020, which, if there's any, with a known fixed supply, if there's any spike in demand between now and 2020, these things could go very high. So utilities who are long cash at the moment, long cash, can't get anything in money market, appear to be not very interested in the price going much below 15 euros right now. There seems to be a change in mood, and don't trade on that recommendation, assuming when it goes to 12 tomorrow. But, you know, there seems to be just a massive resistance around 15 at the moment, and I don't know, that seems to be utility buying.
An additional question. Okay, I mean, this is very much a scenario thing. I mean, probably the one thing keeping these things from really going up is lately is just the pressure on the euro and this possible outlier prospect that the euro goes away. Is there contingency plans for that?
What, in terms of the currency?
In terms of the program.
Well, the euro going is not going to be disastrous for the ETS. It will just go into a different currency. So it doesn't. I mean, the breakup of the European Union, should that be a consequence? Yeah, clearly there would be an issue there. But the euro breaking up, you just switch it into another currency. There's no issue. I should also just say about phase 3, and actually it's a critical thing that I've missed out of this, is the way that the Europeans have been so successful in implementing this scheme is because in phase 2, almost all the credits that you initially you get are allocated. They're given to you for free. So if you, in year 1, if you, at the start of the whole thing, if you produced 1 million tons of carbon last year, you got 1 million tons of carbon credits given to you in year 1. Each year you get given a lesser and lesser amount as the carbon. So all your risk managing at the moment in terms of the market is the difference between what you were allocated and what you're actually going to need. So you're just risk managing that part of your book as a utility at the moment, between what you were allocated and what you're actually going to use. As we go into phase 3, the allocation disappears. We're switching to auctioning of the underlying product. Now that is going to change the game altogether. And again, might be part of the reason for the uptick now. But because at that stage, you're not going to be risk managing just the marginal book, you're risk managing the whole book. And you're risk managing the whole book through until 2020. So there's a huge potential change in the way that the system works in Europe, and a huge change in the way that people need to use the market to help them manage the risk. Yeah.
Who will be allowed to purchase at those auctions? Only the people
Anyone.
currently being allocated?
No, anyone. Auctions will be open to everyone. And clearly the European Union are a bit obsessed by small and medium access for SMEs, but they will be open to everyone.
The other question is these CERs, the supply of EUAs is fixed, But if I go out and invest in a project in Sao Paulo and create a CER, do we now have more supply?
Yeah, the CER supply is a very interesting one. I mean, the process of getting CERs through the United Nations is an extraordinarily difficult thing. And that's why there's this backwardation in it at the moment, because getting the projects through the mechanism has just been extremely difficult. There's about 4.5 billion tons of credits in the system trying to get through, and so far I think 180 million have actually dropped out the other side. So there's a shortage in the near term. In terms of that, yeah, the limit, if you like, is that you can only use 12% of them
In any given year.
in any given year. So that's the limit in terms of the supply. So even if there's an oversupply of CERs, you can't use them, or you can only use them up to a maximum of 12%.
Is each company limited to 12% or is each nation limited to 12%?
In fact, each nation, 12% is the average across Europe. Each nation has each of the 27 member states has its own rules. Some are 0. Germany is the highest at 20%. So it changes from nation to nation. And if we go back and look at that, Japan in terms of the system that they're looking at introducing, because Japan is quite an efficient producer of electricity already, they're actually going to be offering a far higher percentage of CERs to be allowed in the Japanese system. So it's a national decision and it changes per country. The average in Europe is 12%.
But is each company then, say within England,
Yeah. Yes.
limit each company? to
Yes.
that same percent?
So the decision on the number of CRs or the percentage of CRs is a national decision, and the national regulator hands that down to the companies within their borders.
What have you seen as far as the progression of non-hedging type traders coming into the market, and is there a trend there at all? I know
Well,
limited volatility there. I think that might be slightly less attractive.
yeah, I mean, it went through that volatility. I mean, through a very flat period in terms of volatility for almost a year. It's very difficult to track exact numbers, as you know. I mean, each of the energy companies in Europe now has a spec desk, an arb desk, and a hedging book. So even if I look at Shell or BP, I can't say that. They have they have a desk for each. So it's difficult to say. I mean, clearly, just intuitively in terms of my own volume numbers, I can see that there are more and more and more people, about somewhere around 20% of the volume that we do every day is from the US at the moment. So, those people are clearly have no interest in terms of, or no compliance target as it's known. I think it was, over time one would expect it to norm to the same as all other commodity markets, that you will have probably 98% of volume driven by non-industrial players, but probably only about 20% of open interest controlled by non-industrial players, I would suspect. Yeah.
Who are the primary market makers?
Market makers?
Yeah,
It's different for each of the, on the EUAs we've got, God, I can't even remember. We've got a utility, a couple of funds. I think we've got 3 market makers on the EUAs, 3 on the CERs, and 3 on the options there or thereabouts. Frankly, the market, the bid-offer spread in the market on any moment is way narrower than the market maker requirement. So you've got lots of depth there at any time. The market makers are very rarely at the front of the stack at the moment.
You said you had 95% of the volume on the exchange. I thought it was like 50 for the OTC brokers.
Yeah. Sorry. We always have a big argument about this. It's kind of changing over time, but about on the exchange, and if I go back to a screenshot, we have stuff that's done on the screen, and then we have stuff which is booked through the brokers. So we have volume on the screen and volume through the broker market, and that I wouldn't describe that as OTC. I would just describe it as telephone broked business in an exchange product, but in the same way as you do have on certainly other European exchanges. So I don't think that's OTC. What you're buying or selling there, or what the brokers are buying and selling on the phone, is an ECX contract, and if ECX don't clear it, it's busted. So it's, in terms of the percentages there, it's been shifting quite dramatically recently, and we're probably, I think, sitting at about 65% is just straight on the screen, and about 30%, 30-35% is through the EFP market. Most of that 30-35% is big, lumpy, multi-legged trades. You know, you can do pretty much, well, you can probably do certainly 200,000 tons aside within 1 or 2 cents of the market. So if you're doing much bigger lots or multiple leg trades, then you're likely to be prepared to pay the extra to get it done in the broker market.
What's the correlation between AUs and the CERs?
Well, you can see you can see that they're pretty closely correlated.
No, not the AUs.
Oh, between AUs. To be honest with you, I don't know what the AUs correlation is back to EUAs. Not sure. AUs are not a commoditized tradable product in the same way as EUAs are.
You can bank phase 2 credits into phase 3.
Yes.
You cannot borrow from phase 3 back into phase 2.
That's
However,
correct.
within any given year of phase 2, you can bank or borrow because you're allocated in February and you true up in April, right?
That's right.
Do you see people borrowing?
Well,
That borrow is not going to happen.
Well, again, in terms of the imperfections of the system, you're absolutely...
Like a spot month shortage is very hard to come by because
Yeah.
you get one extra year.
Exactly.
So you're never going to have that craziness,
Yeah.
except perhaps
In 2012.
Phase 3.
Yeah.
So are you seeing a lot of that borrowing?
Well, yeah. I mean, certainly there was a big, during the depths of the recession, when there was this, suddenly there were a lot of utilities who were in. I mean, let's face it, a lot of industries who were in trouble, looking for cash, needed cash to pay salaries, and suddenly they look and they've got this asset, which they've been allocated essentially a year ahead of when they need it. So there was a lot of selling of those positions through early 09, no question about it. And how much of it was then being hedged in the futures market, I think we're only going to really see the true impact of that in 2012, when suddenly you've essentially got 2 years with only 1 year's supply. So there was definitely activity there. The extent of it, it's difficult to say precisely.
For phase 3, do you anticipate having to change the futures contract significantly with phase 3?
Not on the EUAs at all, definitely not. EUAs are EUAs are EUAs. It's a commodity. There's no difference between EUAs. CERs and EUAs, we've got contracts through to 2014 already. So we're already trading. The 14 doesn't trade very much. The 13s are reasonably active every day. So for EUAs, not at all. For CERs, definitely. And CERs, we only trade through until 2012 at the moment, because the European Union are still making decisions about how much they're going to accept, what type of projects they're going to accept. And there's likely to be a fairly significant change in the CER market moving into phase 3. Because if we go back again to that, to that diagram there, when this thing was set up, the anticipation was that, everybody from around the world would be buying these things from the developing nations. Now Europe's a bit pissed off. We're the only guys buying these things, and we're not that happy about it. So how much longer we're prepared to continue doing that is what's being debated at the moment, and whether we're prepared to just continue sucking up all the sort of industrial gas projects, or whether we want them to be a bit more greeny, cuddly, feely, touchy-feely stuff. Those are what the decisions the policymakers are making at the moment. So EUAs, no difference. CERs, yeah, there's definitely going to be changes, but we're not launching the post-2012 CERs until we've got greater certainty, because you wouldn't want to trade it.
There's a registry for CERs, though?
Yeah, it's the same registry for both. Yeah.
And a CER that I were to purchase now would continue to exist and be able to offset the EUA in 2015?
CERs, yes. And again, the rules get a bit complex around CERs beyond 2012. So, and I'm probably not confident to tell you exactly how the rules might change post 2012. So, the anticipation is that, in terms of CERs, that at the end of phase 2, everybody's just going to max out to get rid of whatever CERs they've got, and certainly they're going to max out on getting rid of the worst industrial ones. They might, if they keep any, they'll keep the greeny, nice sort of stuff, and they'll max out on selling getting rid of any industrial gases and things like that.
Once it hits the secondary market, isn't a CER just a CER?
No, it still has project flavor, and we accept any CERs in delivery on ECX except large hydro projects. Because large hydro projects, and sorry, amongst the 27 member states, there's still some disagreement about the environmental credentials of large hydro projects, in that they produce lovely clean power, but you have to mess up entire communities to get them. So I think Denmark and one other country are still kind of resistant to large hydro CERs, so we exclude them. So when you get a CER in your account, it has a reference back to the original project type, and we exclude large hydro from that. So CERs aren't a currency in the same way that EUAs are. They still have a flavor to them. And although the vast majority are usable within phase 2, there are exceptions. Be cautious of that, and just make sure you understand the rules around it.
Isn't that basically because you don't know what each project's going to produce?
No, you do. By the time you get the stamp on it, you know everything about it, and it's confirmed, and the additionality and the environmental impact is completely known by the time it gets a stamp on it.
Isn't there a verification process?
Yes.
So they're post-dated, really?
Yes, they are.
So that they're whatever they
Once they're set, yeah.
If you were an investor in a project, you wouldn't really know what you're going to get until they go through the verification.
Yeah, and there was a bit, again, there's been some big issues around that, because, you've got project developers who are saying, I've got 50 million tons of projects at 15 euros a ton. No, they haven't. They've got potential projects. The process of getting those projects approved and through is immensely complicated, and the success rate is immensely small. So, and if they don't get that stamp, they're VERs, and they're going to be worth a tenth of the price. So, yeah, be wary in terms of the primary market in terms of CERs. It's only when it's got that UN stamp on it that it has a commoditized value, and you can bung it onto the exchange.
I think we're going to, if you want to ask one last question.
Yeah, on the registry, is there publicly available information about how many certificates are in the registry, and is it broken down by owner sector, like utilities, speculators?
No, it's not broken down. Anybody can open a registry account, and each country has its own registry account. And no, there is not public information in terms of what the ownership structure is.
The total number of certificates in the registry, is that available?
Well, the total number of EUAs are known, and there isn't a single registry. Remember, each country has its own registry. So in terms of EUAs, it's a known number. Yes, in terms of CERs, it's a known number. So the overall number is known.
Okay. I want to thank Patrick for joining us today. This was probably the most questions that we've had at one of our seminars. So this was, obviously a very interesting topic. If you are an Advantage client and you've got questions about getting set up for trading, feel free to contact your client representative, or just email us at contactus@advantagefutures.com. And again, there's Megan is here in Chicago if you've got questions, follow-up questions as well. So thanks again, Patrick.
Great pleasure. Thank you.